You see these house prices? They look real, they feel real, but I'm going to show you why they are a dangerous illusion. What the mainstream headlines are missing is the one number that changes everything. The number of actual sales has completely collapsed. We're now in a psychological market, one that's frozen by a massive lock-in effect. Today, I'll show you the data that proves the housing market isn't stable, but is actually on a knife's edge. What you're about to see will change how you view the price of every home in your area. Think about it for a second. If housing prices are so high and stable, why are actual home sales falling off a cliff? And if the market is so strong, why do sellers have to keep cutting their prices just to get a single offer? It just doesn't add up. What we're witnessing isn't a normal housing market. It's a phantom market. The prices you see listed on Zillow and Redfin are not real market clearing prices. They're ghosts. They are the hopeful wishes of sellers who are psychologically and financially trapped in their own homes. The entire foundation of the housing market is built on one thing: transactions. Buyers and sellers agreeing on a price and exchanging keys. But what happens when that engine breaks down? What happens when the number of sales plummets to historic lows, yet sticker prices barely budge? You get an illusion of stability, an illusion of wealth, in a dangerously fragile market that is staring down a sudden and dramatic correction. Today we're going to pull back the curtain and expose what's really going on. Let's start with the single most important yet least discussed data point in housing today: transaction volume. Everything in a market, from a stock to a gallon of milk, gets its price from the simple act of a sale. Price discovery can't happen without transactions. Without them, a price is just a number on a screen, completely disconnected from reality. And that is exactly where we are right now. Consider this. In a normal, healthy year, we see between 5 and 6 million existing homes change hands in the United States. But as of November 2025, the annualized rate of existing home sales is hovering at just 4.13 million. While sales have ticked up for 3 straight months, this is still a massive drop in activity that has brought the market to a crawl. Sales are down 1.0% from just a year ago, and that year was already considered slow. Think about what that means in real terms. Millions of transactions that should be happening simply aren't. Millions of families who would normally move for a new job, a growing family, or to downsize are staying put. The normal churn of the market has ground to a halt. Now, here is the paradox, the very heart of the illusion. While sales have slowed dramatically, look at what prices have done. The median existing home price in November 2025 was around $409,200. That's a tiny 1.2% increase from a year ago. How is this possible? How can the number of sales fall by the millions, yet prices stay stubbornly, artificially high? Basic economics tells us that when demand collapses, prices should follow, but they haven't, not yet. The answer is that we're no longer in a market driven by traditional supply and demand. We are in a market frozen by psychology. This matters because when markets stop clearing, regular people get trapped. Buyers are trapped by unaffordability, and sellers are trapped by their own expectations and their golden handcuffs. This isn't a stable market, it's a broken one. And broken markets don't just bend, they shatter. So why has the market frozen? It boils down to something economists call the lock-in effect. But a much better term for it is the golden handcuffs. During the pandemic and the years before, millions of American homeowners refinanced or bought homes at once-in-a-generation mortgage rates. We're talking rates below 4%, even below 3% in some cases. As of the second quarter of 2025, a staggering 52.5% of all homeowners with a mortgage have a rate below 4%. Even more telling, just over 80% have a rate below 6%. Now compare that to today. As of mid-December 2025, the average 30-year fixed-rate mortgage is hanging around 6.2%. While that's down from its recent peaks, it represents a monumental difference in your monthly payment. Let's put this into perspective. Imagine you're a family who bought a $400,000 home in 2021 with a 3% interest rate. Your principal and interest payment is about $1,686 a month. Life is good, but you get a fantastic job offer in another state. You start looking at buying a similar $400,000 house there. But at today's 6.2% rate, that same mortgage would cost you $2,449 a month. That's an extra $763 every single month, or over $9,100 a year just to make a lateral move. You are financially handcuffed to your current home. Would you sell? Would you willingly ditch a 3% mortgage for a 6.2% one, instantly making your life thousands of dollars more expensive for the exact same house? Of course not. This isn't just a few people making this choice. This is the math being done by tens of millions of homeowners across the country. They are locked in. They can't sell, and they won't sell unless they're forced to by a major life event like a death, divorce, or a desperate job relocation. This mass paralysis of sellers is why inventory is so tight and transactions have vanished. It's not because there's a fundamental shortage of homes. It's because the homes exist, but they're not coming to market. As of November 2025, newly listed homes were down a sharp 8.3% from the year before. Sellers are on strike. This is the mechanism that creates the illusion. With so few homes for sale, the handful that do get listed can still demand high prices from the few desperate buyers left, creating a completely misleading picture of market health. And that brings us to the listings themselves, the Zillow and Redfin prices that shape our entire perception of the market. These prices don't represent real market value. They represent a seller's refusal to accept a new reality, driven by powerful psychological forces like loss aversion and anchoring bias. Loss aversion is just a fancy way of saying that losing hurts about twice as much as winning feels good. For a homeowner, this means they would rather let their overpriced house sit for a year than sell it for $20,000 less than what they believe it's worth, even if that belief is based on the peak prices of 2022. This is tied to anchoring bias. When a seller sees that their neighbor's identical house sold for $500,000 2 years ago, that number becomes a powerful psychological anchor. They list their home for $500,000 even if the market has completely changed. That price isn't based on today's buyers or today's mortgage rates. It's anchored to a past that no longer exists. So what happens? The house sits and sits and sits. The data on this is crystal clear. In November 2025, the average home sat on the market for 54 days. That's a full week longer than a year ago. Zillow's data, which tracks how long it takes for a home to go under contract, confirms this slowdown, showing a median of 29 days. While the numbers differ slightly, the trend is obvious. Homes are taking longer to sell. And what do sellers do when their house isn't selling? They cut the price. Slowly. Painfully. In November 2025, over 21% of all listings on Zillow had a price cut. This shows a market where initial asking prices are fantasies. A listing for $500,000 that gets cut to $480,000 and then $460,000 before selling doesn't mean the market is strong. It means the seller's initial hope was wrong from the start. Listings are not transactions. They are an advertisement of hope. And in this market, that hope is colliding with the hard math of what buyers can actually afford. The result is a standoff. Sellers don't have to sell because of their golden handcuffs, and buyers can't buy because of punishing interest rates. This creates a market with a dangerously low pulse. The supply of inventory in November 2025 stood at 4.2 months. While that sounds low, it's artificially low because it's based on a collapsed sales rate. The reality is that the number of homes for sale is actually up year over year by 7.5% according to the NAR and 14.5% according to RE/MAX. More homes are sitting, but the prices don't reflect it because no one is blinking first. All right, I want to pause here for a second. We're getting deep into the data, and if you're finding this analysis valuable and it's helping you see the market in a new light, do me a favor and hit that subscribe button. My goal on this channel is to give you the unvarnished truth backed by real numbers so you can make smarter financial decisions. Subscribing ensures you won't miss the next deep dive. Okay, let's get back to it. This is where the story gets even stranger. While sellers are locked in and refusing to list, there's a vast and growing supply of homes that are already sitting completely empty. This is the shadow inventory that almost no one is talking about. According to the U.S. Census Bureau's data for the third quarter of 2025, a stunning 10.3% of all housing units in the United States were vacant. Let that sink in. 1 in every 10 homes in America is empty. Now, the mainstream narrative will quickly try to explain this away. They'll say, oh, those are just homes for sale or for rent. But the data tells a different story. The homeowner vacancy rate was just 1.2%, and the rental vacancy rate was 7.1%. The majority of these empty homes are not even on the market. The census data shows that after you account for homes for rent, for sale, sold but not occupied, and seasonal homes, there is still a massive chunk classified as vacant year-round. In the third quarter of 2025, these other vacant homes made up a huge portion of the total, leaving about 8% of all housing units vacant for year-round use. What are these millions of empty homes? They're a mix of everything the official statistics struggle to categorize. They are investment properties held by investors waiting for the right time to sell or rent. They are second homes that aren't technically seasonal. They are homes tied up in probate, homes needing repairs that owners can't afford, and even homes that have just been abandoned. This is our shadow inventory. It is a massive, looming supply of housing held off the market, completely invisible to your typical Zillow search. This phantom supply ensures that even if demand were to magically return tomorrow, there is a hard ceiling on how high prices can go before this inventory starts to leak back into the market. It shatters the simplistic narrative that we just have a housing shortage. We don't have a physical shortage of houses. We have a circulation problem. The market's plumbing is clogged. The golden handcuffs are keeping existing, occupied homes off the market, while a combination of financial speculation and economic hardship is keeping millions of other homes vacant. It's a market that is simultaneously starved of listings, yet glutted with empty properties. Now, a popular story you'll hear is that this is all the fault of big Wall Street investors like Blackstone. They're buying up all the houses and manipulating the market. It's a compelling narrative, but it's mostly a distraction from the real issues. Let's be clear with the data. In the second quarter of 2025, investors bought a near record share of single-family homes, around a third of them. But this wasn't because investors went on a massive buying spree. It happened because regular, everyday buyers have been so thoroughly priced out by high rates that they've vanished, leaving investors as the only buyers left standing. The actual number of homes investors purchased really went down, and the boogeyman of the giant Wall Street firm, it's largely a myth. More than 90% of investor-owned homes belong to small mom-and-pop landlords who own 10 or fewer properties. The biggest institutional investors, those with over 1,000 homes, control only about 2% of all investor-owned homes and have actually been selling more than they've been buying for 6 straight quarters as of Q2 2025. The big firms are pulling back, while small investors are filling the gap. So while investors are a significant part of the market, blaming them for the entire affordability crisis misses the much larger picture. The crisis isn't caused by a conspiracy of Wall Street villains. It's caused by the toxic combination of low-rate lock-in and high-rate exclusion. The real villain isn't Blackstone, it's the math. When it all comes down to it, there is one force that no market can defy forever: the ability of the end user to pay. And right now, the average American family simply cannot afford the average American house. The data on this is brutal and undeniable. By late 2025, Zillow's data showed that a monthly mortgage payment on a typical home was eating up 32.6% of the median household income. And that's after a slight improvement from nearly 36% at the start of the year. This is way above the traditional 28% benchmark for affordability and represents a level of financial strain we haven't seen in decades. This isn't an opinion. It is simple, cold arithmetic. With home prices near $410,000 and mortgage rates over 6%, the barrier to entry has become a concrete wall for millions of would-be buyers. This is especially true for the biggest demographic group in American history, the millennials, who are right in their prime home buying years. You'll often hear the argument that demographics are destiny, and this huge wave of millennial and Gen Z buyers will keep prices high forever. But that argument misses the most critical point. Demographics create desire, but they do not create affordability. You can have millions of people who desperately want to buy a home, but if they can't qualify for the mortgage or afford the payment, their demand is economically meaningless. It doesn't turn into a sale. This is the great standoff we are in. Sellers are locked in by their 3% rates. Buyers are locked out by 6% rates. And the prices you see online are the phantom apparitions caught in the middle, reflecting a market that was, not a market that is. So let's bring it all together. We have a market where the number of sales has dropped to historic lows, meaning the very mechanism for discovering prices is broken. We have tens of millions of homeowners who are handcuffed to their ultra-low mortgage rates, preventing them from selling and choking off supply. We have sellers who are anchored to the peak prices of the past, refusing to accept the reality of today's buyer. This leads to stale listings and a slow, painful drip of price cuts. And we have a shadow inventory of millions of vacant homes, proving our problem isn't a lack of supply, but a catastrophic failure of circulation. The prices you see online are not a reflection of a healthy, stable market. They are an illusion, a mirage created by a unique and toxic cocktail of economic forces. They are phantom prices in a frozen market. The critical question is, what happens next? This stalemate can't last forever. Markets are like water. They eventually find a way to flow. The pressure is building. On one side, you have the immense pent-up desire of a generation of buyers. On the other, you have the immovable reality of unaffordability. When markets stop clearing, they become fragile. And fragile markets don't adjust smoothly, they adjust suddenly. A rise in unemployment, a slowing economy, or just a shift in psychology could be the pin that pops this bubble, forcing sellers to finally capitulate. The illusion of stability is the most dangerous phase of any market cycle. It lulls people into a false sense of security right before the floor gives way. The question is not if the housing market will find its true level, but how quickly the illusion will shatter and who will be left paying the price. What are you seeing in your local market? Are homes sitting for longer? Are price cuts becoming more common? Let me know in the comments below. I read every single one. Thanks for watching.